What is the
Thank you.
one game changer in self-storage compared to other asset classes?
I mean, the game changer is first of all, there's a lot of components,
Hmm.
and you have to look at every component as far as map out the process, from the construction to financing it, from taxes. The taxes could be a killer if you don't do it right. And Bill and I have a system, and we are an expert on that. 7A, 7B, TIF. How to get some of these tax incentives working for us, right? And so, using the methodologies of Six Sigma Lean, you have to make sure that when you're even building it, that you're building in a way that everything's on time. If it's not on time, you're paying interest. People, you can't build the building, and a lot of losses come from that. And so, time management is so critical. Looking at all these different projects and builds.
Today's episode is about powerful asset class that's been quietly building steady wealth even during tough times, self-storage. If you're tired of tenant toilets and turnovers and want a real estate strategies that's scalable, operationally lean, and built for long-term cash flow, you're at the right place. Joining me are two powerhouses behind some of the biggest Class A storage developments across the US. Bill Kanatas, co-founder and CEO of self-storage developers, who's partnered with major players like Public Storage and Extra Space, and Ben Salzberg, co-founder and CEO of Six Sigma Black Belt with over 25 years of experience scaling high-performing commercial assets. Oh my God, Ben, I didn't know you're a black belt in Six Sigma. Me too.
How are you? Wow, that's great. It's a small world. I was class number one for Motorola
Wow.
and General Electric also. So I have two master black belts in Six Sigma. I
Wow.
consulted thousands of people, such as like Amtrak, AbbVie, ADP, turning them around and really building their company. And like Bill and I are building our brand, self storage. And so it's a handy tool to have when you're doing these different projects.
That's true. And I'm pretty sure you are like a really big help staying lean, that's the best thing. By the way, welcome you both to the Wealth Wife Show. I'm really excited for our conversation today. And our today's topic is unlocking financial freedom through self-storage. So we're gonna be digging in deep, and especially you're talking about lean and your black belt. Oh my God, it's gonna be super
Should I wear my boots? Should I put my boots on and grab my shovel? Yeah, I love that, to dig deep and, to explain to your listeners, what we've done.
Yeah, so let's start with Bill. Well, let's start with the mindset. What was your turning point when you realized self-storage wasn't just real estate, it was a long-term wealth vehicle? I know you background in car washes and stuff.
Sure. Well, after we developed the car washes, we really were looking at other opportunities. Even a car wash has a limited amount of employees, right? So you have about 3 employees in a car wash. So that in itself was lean. But the one business that survives all the time, it's resilient is self storage. So in good markets, it does well. In bad markets, it does well. And the reason is everybody needs self storage at some point of their life, right? And when you talk to other self storage operators, a lot of people talk about the 4 Ds. I mean, what is it that really drives a self storage? So when there's death is one of the Ds. So when somebody dies, the children are looking to put their stuff in self storage, right? Obviously, the another one is a divorce. So when people are going through a divorce and they're looking to sell their assets or put their assets in storage, that's another one that we see. Dislocation, you see all the time too. People are moving, job relocation, or their temporary housing. They're also looking for storage. My daughter was at school, and during COVID, we had to take her stuff out. And what do you do with it? You got to put it in self storage. And then obviously, you have downsizing. Not only are people getting smaller homes, people are moving their businesses. So the thing that really, really appealed to me in self storage is there always going to be a need for self storage. And with Ben will tell you to this a little bit later in the show, when you're only having one employee really working, you don't need to have 10 or 20 people coming to work and you have to worry about that payroll. And we use institutional players to manage these assets for us. So I don't have to go there at 8 o'clock in the morning if a tenant calls and says, I can't get in, I lock myself out. These are institutional grade. And there's just so many more things that we'll talk throughout the show about the benefits of owning a self-storage facility.
Thank you for sharing that. So, well, let me come to you with this question. You come from a background rooted in process, efficiency, and operational excellence, because we're talking about Six Sigma Black Belt over here, which is such an honor today to talk to you. What is the
Thank you.
one game changer in self-storage compared to other asset classes?
I mean, the game changer is, first of all, there's a lot of components,
Mm-hmm.
and you have to look at every component as far as map out the process, from the construction to financing it, from taxes. The taxes could be a killer if you don't do it right. And
Mm-hmm.
Bill and I have a system, and we are an expert on that. 7A, 7B, TIF. How to get some of these tax incentives working for us, right? And so, using the methodologies of Six Sigma Lean, you have to make sure that when you're even building it, that you're building in a way that everything's on time. If it's not on time, you're paying interest. People, you can't build the building, and a lot of losses come from that. And so, time management is so critical. Looking at all these different projects and builds, and so the game changer really is to making sure that everything is mapped out, the systems are properly done from A to Z, and that's even finding the property,
Mm-hmm.
acquiring the equity, acquiring the money, which is the equity, but by looking at the entire picture, because it's not just say, hey, let's go build this. There's a lot of components involved in building anything, but self storage, specifically A class, because on the average build, it's a lot of money. It could be like $15 million projects. And so these are not like the type of like facilities you see on the side of the road. You have these little pods, right? You see, these are nice, climate controlled. Could be nine. We have a 900 unit building facility, so they're big and they have to be done right. And so having the knowledge in Six Sigma engineering, as I'm an engineer, a mechanical engineer, allows us to understand all these components. And with Bill's financial background as well, it just puts it. We put it all together just right.
Wow, that's good. And then you're going whole 9 yards. So share with us, how you're still staying lean or using your lean approach to from the cost perspective as well, staying lean at the same time getting more profitable.
We use value streaming. We make sure that the process map and the values and the steps are done properly to map everything out, to make sure that we don't overdo a step or go back, to make sure that those timings and the time studies to do it. So I do a lot of time study. I do a lot of, looking at taking away the inefficiencies, mapping out the people involved, looking at the entire project, like I said before. So Bill and I, review these continuously, review, what's happening on a daily basis, who we need to call, making sure that we don't go back and repeat that step again. So it's very important, because if you go back and repeat a step, that's a lot of time spent doing that, but it also costs money, because time is money. And we have some investors with us, which they want to make sure that their money is being placed properly and we handle it right. And so Bill and I make sure that those are handled properly in a very fast momentum, and get it right the first time. And so,
Thank you.
as you know, just in time, that's what we use. We use a just in time strategies to make
Just
sure
in
that
time is
everything.
very good, but how do you handle that with your, or since you're doing ground up, right? So just in time approach works for all the materials and everything, you think? There's no delays?
Yeah, yeah. I mean, if you don't mind me taking this, the just in time, as far as the materials stuff, we have make sure that everything is already bought. A lot of our suppliers already bought the materials and the steel, and
Mhm.
everything costs are secured. And Bill looks at make sure that those costs are secured before we even
Right,
start building.
right.
Yeah.
I think one of the
Yeah.
biggest lessons of Vinky for any developer, to be honest with you, is it's important to stay disciplined on your underwriting, right? Because we all think, oh wow, this is beautiful piece of property, and sometimes we underestimate what the costs are going to be in a project, and also more importantly, underestimate the time it's going to take, right? So one of the things that's important that Ben and I do together is before we jump into a project, is we overestimate on our underwriting that it's going to take a little bit longer than we expect. It's going to cost a little bit more money and things just don't go as planned when you do developments. But if you build a strong foundation on the project and with your team, then you can weather the storm no matter what it comes, right? So if there's a delay on the steel, you kind of can shift something else that can be done at that time while you're waiting for that steel to come in. But
And
with any
the,
development project, it's important to really overestimate the cost and the timeline. And then if you tell the investors, hey, in 18 months, we're going to be open, and you open up in 16 months, hallelujah. If you open up in 12 months, oh my gosh, it's a grand slam, right? So what's the old saying? You under promise and over deliver.
Over deliver.
Yeah, of
That's where
course.
you speaking. That's where you do probability studies and see, what the probability of things happening, and that's what my engineering Six Sigma is all about, is forecasting and doing different probability studies to make sure that it's done right first time.
Yeah, see, I love that cross pollination right there, bringing the knowledge from the tech world or your previous job in the corporate world and applying it here in a near way, near fashion. I don't know if all the approaches work like just in time. I'm not sure how much it works, but still you're getting the material ahead of time. You're negotiating all the contracts ahead of time.
Because
You're getting the best deal of both worlds, basically, doing
Right,
that.
because you do need the steel in time, just in time for when the foundation's poured. You need that steel. You need that, just in time before it's erected. So you need everything to be clicking, and as a machine, right, as a process, and that's what Bill and I really adhere by to make sure that we're through my lessons and teachings in 20+ years, 25 years, that I bring that knowledge into this company.
That's good. And I hear that Bill saying that the foundation has to be strong and then you're working towards that, which is pretty awesome. So, Bill, this question is for you. What is the playbook for identifying a great class A self-storage opportunity versus an average one? Is it location, competition, or supply and demand? How you determine that?
Yeah, that's a great question. All of them. We're still very bullish on storage, but we're very selective between the interest rates, construction costs, market saturation you just talked about. Those are real challenges.
Mhm.
And getting into the space, we really need to look at underserved pockets, right? You got to understand the supply and demand, the dynamics, and you can't cut corners when it comes to your design or your site selection. So we look for certain per capita, right? So you look at populations. We look at a 3 mile radius, and we look for populations that have 75,000 people or more. So it's a dense population. And per capita, we really like to develop things under a seven per capita. So that's 7 square feet per person in a 3 mile radius. But the one that we're doing right now in Chicago Ridge, I think, Ben, we're what, 4.5% per capita. We're
Mm-hmm.
looking at another one in the St. Louis market. We're 3.5 per capita. We have one in California that's in the mid to high threes.
Three.
So the lower the per capita, the better. It shows that there's a demand in the area. And then we look at the household medium income in the area. We also look at the renters. Is there a lot of renters in the area? Because renters tend to use more self storage. And then, obviously, as you probably know this, with newer homes being built and smaller homes or homeowners, in addition to rentals, we have now homeowners associations that are not allowing people to park, their extra, you know, uh, car, let's say, in the driveway. So our self-storage facilities that we develop also have, outside exterior doors that are also climate control, especially
Mhm.
like in the Midwest in Chicago or Indiana and Wisconsin. And you could drive your car in there close the door behind you, and leave it as climate control.
Mhm.
Nice. Isn't that better, right? It's like self-storage is like really much better now than before because the one that we have, that's a climate control as well. Because I know a couple operators, who they do mom and pop, they're getting those and kind of improvising those and just making it better. But I'm not sure if there's gonna be at the similar level like you guys are doing, right? Brand new
Right.
ground ups.
Yeah, we have the drive right through the building, which is fantastic, right? Where you can park your car inside there, unpack it, and then you just drive right like straight ahead. You don't have to back up. So, which is fantastic. And it just you're out of the elements. There's no wind. There's no heat. And especially in the Chicagoland areas, depending where you're at, or even Arizona, it's 120 degrees in the summer. You don't want
Right.
that. And
Right.
so it is very good to have a drive-through facility. But if you do retrofit, right? If you convert a building, you may not be able to do that because of how the building is. And that's why ground up sometimes, in most times in good areas, is worth to do.
Okay, so let me ask you this question. I'm gonna get viewpoint for both of you. A lot of our listeners, a lot of people, I would say, they invest in multifamily or single family because everybody, thinks that multifamily is recession-proof, recession resistant. So, what sets storage or self-storage apart in terms of risk, returns, and freedom?
Well, I tell you one thing, if you don't mind, Bill. I'm sorry.
No, go ahead.
I can tell you one thing that self storage. If somebody doesn't pay you for the 1 month, you're pretty much evicted next month. Try doing that in a multifamily facility. You have to go to court. You have to get them evicted. Not in self storage. You can throw them right out. You can adjust the rates every month if you want to. Can't do that with the multifamily. It's a really different asset class. And then the taxes, which Bill will get into later on, there's depreciation for cost depreciation when you build these things. There's a lot of stuff that is incredible as far as investment for self storage, but you have to do it right. A lot of people try to get into self storage or even build multifamily, which they don't have that knowledge base. So Bill and I really have that knowledge base to go
Right.
forward. And
Mhm.
Bill can. Sorry, Bill.
No, I was going to say, I love multifamily. I've owned a lot of multifamily in the past. I don't have it in my portfolio anymore, but I do have a lot of respect for multifamily operators. There is a lot of work, in my opinion. The reality is, uh, tenants come with turnovers, right? Regardless if it's self storage or it's multifamily. But the difference is you don't have the toilets or the trash or the legal risks that Ben just mentioned. In self storage, we still have customers, but it's much easier and it's a simpler relationship, right? Because it's month to month versus year to year. And you don't have the midnight maintenance calls or the eviction in courts or the lawsuits. If a customer stops paying, to Ben's point, it's a lien process. It's not a 6 month. In our county, Cook County, they're 12 months behind right now. So not only does it take 12 months to get somebody out, you're not getting any revenue during those 12 months. And then you pay all your court costs and your legal costs. And then when you finally take possession, you have no clue what they've done to your apartment, right? There may be water, there might be leaks, there might be damage, there might be painting. So as much as I love multifamily, and there is certainly a need in this country for more of it, boy oh boy, when you compare that to self-storage, it's night and day. It's a lot much easier, in my opinion, to operate self-storage than it is in multifamily.
So I heard one thing you were saying, no toilets in the self storage. The newer self storage they're coming up. I think they're saying, somebody shared a deal with me. It's like the luxury self storage. They have the similar thing, like you can drive up to your unit and then you can just dump all the stuff and everything. I think it had a little kitchen too in there. They mentioned, if I recall that. And also they were saying they're gonna have like public toilets, like everybody can use it in the facility. Have you heard about that?
We do have
It was in
restrooms in our
Houston, I
facility.
think, or they built this luxury self-storage, and it was mainly for the ultra-rich people to store their, ultra expensive cars.
There are opportunities that Ben are looking at right now where it's a year to year lease and you're renting somebody out about 1,000 square feet that might have a bathroom in there, a small office, and a mini warehouse where they can operate their storage business, if they had like an Amazon account, to give you an example, or a
Mhm.
small electrician or a plumber that needs to have some storage for himself, but he also wants to go in there and write his bills to his clients. So we're looking at that as a possibility. But we love when the REITs operate these for us. And right now, the REITs are not operating these facilities. So until they do, we're kind of just on the outside surface looking in at the moment.
I
Right. So
think
let me
what
ask.
I think
Go ahead.
most people sorry, I think most people are when they hear that it's more of the flex space type of
Flex
model.
space, right?
You know, a lot of people will say, wait a minute, the thing is flex space. It is flex space. And like Bill said, you know, the REITs, you know, we like to have you know, when you build and invest, right, in these projects, you want to see who's going to buy it, right? You want to see, you know, when are you going to get out of it. And our exit strategy, you know, are the REITs, you know, like public or extra space, you know, and some people want to hold them, you know, we'll hold them too, depending on the situation.
So when you're talking about the exit strategy, so what is your timeline? What is your exit strategy? It's like one strategy that you wanted to, 5 years down the road, exit 100%, or you wanted to just have multiple other strategies, maybe create a portfolio and sell it to some institutional investors. What is there from the strategy perspective?
So it's really driven by your investors, your limited partners, your LPs in the deal. If it's a family office that wants to be out in 5 years, then we try to do a strategy where we're 3 to 5 years. If it's a fund that's looking for more of a portfolio sale where we can develop 3 to 5 of those and exit them in 7 to 10 years, that we're open to that strategy as well. There's some people that are looking for immediate depreciation because they have passive income for 2026, let's say hypothetically. So we could do the bonus depreciation. And once they've already gotten that off their books and they have different liabilities and, I'm making this up, 2027 or 2028, then we could look to exit it. So we first look at the investor and find out what is really their goal. How long do they want to be in this? And then Ben and I will, tailor something to fit the investor's needs. But typically, if you ask me, like, hey, Bill, we want to invest with you. What is our exit strategy? I would tell you 3 to 5 years.
5 years.
Yeah.
So people can invest with you without being a developer or without managing the facility, but they can still build serious wealth by investing with you, basically, right?
Absolutely. And the good news now with, as legislation always changes and now we have the big beautiful bill that allows for the depreciation, the bonus depreciation. So between the bonus depreciation and the 179D, which is your credits that you get for energy efficiency, somebody that invests in the property, and by the way, 100% of all the depreciation, 100% of all the operational losses, anything that you can write off on your tax return goes to the limited partners, not the general partners, which would be Ben and I. So the limited partners get the advantages 100% of all those tax breaks. So between all those, somebody can, in the first couple of years, really write off a lot of the income that they have from other investments that they have, if that makes sense. So it makes it even more attractive right now because we have the bonus depreciation, which you wouldn't have in multifamily. You would have the straight depreciation, 39 years for that.
No, we do have bonus depreciation in multifamily too.
I'm sorry, you have the bonus depreciation?
Yeah, we do have bonus depreciation, and it's back now with this big beautiful bill. So it's back to 100% now. I think this year was 40.
Beautiful.
Yeah, it's back. So I think similar thing in the self-storage, but can you guide us, what kind of depreciation or bonus depreciation, paper losses that you're looking for any individual investor?
Yeah, so we just had a study done for our Chicago Ridge project, and it's going to be about a $4.2 million equity raise. And the consultants came back with anywhere from 980,000 to about $1.3 million as the bonus depreciation that you can accelerate in the first 12 months. Because one of the things we have rolling doors, right? So the doors, anything that's kind of can break down is able to be accelerated on the depreciation schedule. So it's about a little bit over 25% of the capital raise that can be depreciated in the first 12 months.
First 12 months, and that goes 100% to the investors. That's what you're
Yes,
saying.
all of it does. Yep, yep.
Interesting. And then the first year on the new development, which is kind of amazing, I think, which is like a big bonus for people to invest, basically. So
Sure.
let me see this question. So what should a passive investor be looking for in a storage syndication or partnership? What red flags should they watch for?
Well, I personally, I think know the developer, right? Somebody that you know and trust. Look at their track record, and then really look and see who's the operator. If it's a public operation like Public Storage Extra Space, more than likely they've also done their homework on the market. They also know the market in that area because more than likely they have other operations in that 1 mile, 3 mile, or 5 mile radius, and they know what their achieved rates are. So when we do our analytics, first Ben and I will spend a lot of time looking at that site, and once we like it, then we talk to our consultants that would also look at that site and also approve it. And then the third thing is to talk to Public Storage Extra Space and have them approve the site, and then they give us a model. What they think it's going to be in 1 year revenue, 2 years, 3 years, 5 years, etc. Also, the absorption rate. Will we get filled in 12 months, 18 months, 2 years, 3 years? And they know that because they have other sites in that area and they can see what the achieved rates are. So they know
and
if they're
and
getting $1.80 here, that they can achieve $1.80 in your location in, I'm making this up, in 12 months or in 18 months, et cetera.
and it's very important to walk the area too, right? I mean, everything is great on a screen
Of
and
course.
forecasting, but it's very important to like to walk other facilities, your competitors. The red flag would be, properties that are underperforming in an area that you want to go into, even though you see it's great on a piece of paper, and you ask yourself why, what's happening. Going into the facilities, asking questions in the area, the neighborhood, is really the best way to kind of uncover these particular red flags.
Sure.
Hmm. So for the project timeline, let me ask you this question. Since you're doing all A-grade properties, finding the land and starting ground zero, so what is the delivery timeline for you guys? From the investor perspective, I would wanted to know, when do I get to see the returns?
That's a great question. So Ben and I pay for all the pre-development and do all the pre-development work on our own before the investors come in. So we'll tie up a property. We will do the borings. We will pay for the architect, the engineer, structural engineer. All that's on our dime, and then we will close with the lender and go vertical with the money from the LP investors at that closing. And then the LLC will reimburse the money that we have already put into date, or will that money will stay behind as equity, depending how it's structured with the limited partners. But then
Mhm.
once we're permit ready and we're ready to pull permits and we close, it's 12 months before we open up the doors. Now, it could be 10 months, and it really depends on where you're building, versus in a cold climate or in a warm climate. It could be faster if this is a conversion versus a ground up construction as well. It could be faster. But the investors, typically the first 12 months would be to get us the certificate of occupancy. Then the next 12 months to get it leased up. And leased up in the first 12 months is anywhere between 30 to 40%, I would say. And then by the second year of operation, you should be in that 60 to 70% range. And then we look to put it in, on the market, depending again on the investor's needs, potentially in the third year. But we remove the risk, in my opinion. The development risk is all on us, not on the investors.
Yeah, because you already done the feasibility study and all the horizontal, everything is done. And when you're
Right.
shovel ready, then you start raising or bringing in the investors at that time. And from there onwards is 12 months to delivery for the development and 12 months to kind of get the lease up, right? That's the timeline
Yeah.
basically.
Yeah, and the lease up on the first year is probably 30 to 40%. It's not going to be to 90%. That's going to take, a couple of years to get there. And revenue wise, the REITs discount the rates to get people in there. They wait 6 months and then they increase everybody's rates. You're going to lose some people at that point. You're going to have more people moving in. So usually it doesn't go down. It might go a little bit slower up as you're losing and more people are coming in, but it's always, trending upwards.
Yeah, and
So
again, it's look at the economy. It's definitely a resilient product, an asset class. Again,
Absolutely.
you're looking at this, say, "Oh my God, do I really want to like invest in something and wait that long?" But you have to look at risk and return too,
Sure.
because when the economy is, uncertainty, you don't know what's going on and stuff like that. This is where self storage comes into play, because again, people can't afford their homes; they have to put their stuff somewhere.
That's right.
People. They're dying, unfortunately. My parents unfortunately passed away. I got myself two storage units. Again, all these different factors come into play. But if you look at the whole picture, self storage is absolutely one of the most fantastic type of investments out there.
So
Like you
I'm
have
gonna
to do it right. You have to do it right. Like you said, you're digging deep, to understand how the system processes work. If you don't have people like me and Bill, we're very knowledgeable, but if you don't do it right, you're in problems.
Yeah, but I'm going to ask you this question. I think this comes to me all the time. I did ask this question at the conference too. So you think in the current environment, in the new Gen Z generation or the new generation Y or whosoever's coming next, they're all about experience, they're experiential generation. You think they're going to have any kind of impact on the self-storage? Because if they're not in the hoarding phase, uh, would it change some dynamics there?
I think what we're going to put in our drive-throughs, we're going to give them cheeseburgers and French fries to come through. So
Well, I mean,
they're going to
this
drive
is where,
through.
we have technology in our units, like wireless keys, with your on your telephones, virtual people meeting you. I mean, like Bill said, having vodka, like, here's a drink when you get in, martini. But you have sites that are technology driven. You have marketing, which they do very well. So I think that this class, I think everyone, every generation, will touch storage.
Yeah, for
They
sure.
absolutely will. And storage is a going to be as common as when you buy a house. I have to have storage.
Yeah.
Mhm. Mhm.
They have a
Yeah,
lot of
go ahead.
I was just going to say that they have valuables too. You'll be surprised at the tenants we have and at their ages. I have a nephew who's 19 years old and he's got storage and he's got stuff that he just has to keep safe, right? We all have stuff. As
And
much as we think we don't collect it here in the United States, we collect things.
and you know
So,
what? And we didn't even talk about the college students. My daughter's college age. She's going to college. I don't want to move all of her stuff back. We put it into storage. And so you don't want to like carry your stuff back home. And so it's a lot easier and simpler just keep it in storage, and then she comes back, she has her stuff. So storage is absolutely the way to go.
absolutely.
Yeah,
We
but
love
usually
it.
when people hear about storage, they think it's boring, because but I think this asset class shining in the downtowns too. So most of the time, like you said, there's like 4Ds, right? So it's just like because of necessity, sometimes you need the storage. So how do you build that long-term resilience for your storage? When people are thinking it's boring, should I do this or should I not do this?
When you mean boring, what do you mean? I mean, let's expand on that. Boring.
Oh,
I
you're
love
hurting our
I love
feelings. It's
self
not
storage.
boring.
Yeah. Self storage. I always tell people, I was a director in charge of like, Amtrak and ADP, and people are like, what are you doing now? Well, I'm building self storage. Isn't that a sexy class? And they're like, what? And like sexy class, what the heck is that about? And I'm like, yeah, I know, but you know what? It's a needed product. Like surgeons, you need surgeons, right, to operate on you. You need everyone in the world, right? And so storage is another class that helps people out. I don't care
Absolutely.
what it is,
You want to add
So
something to
it's a people. It's a people. Storage. You're helping people in their lives, and then it's a people business. It really is.
Yeah, it really
And
is.
it's a helping people business. Bill can tell you about and I help him too about organizations he's with called Feed Six. And he helps people. We help people. We feed people that are food deprived, and
Yeah,
so we're really in the helping business. So people ask us, what do you do really? And I tell people I'm a trustee for a college, by the way, for Oakton College. So I sit on the board. I was chairman of the college. I love helping people. That's the business that Bill and I are in, is to help
sure.
people out, teach people, even storage. People come to us, our competitors. It doesn't matter. We help everyone.
Right.
I
It's
think
a
education
need.
is a must thing, just having the knowledge, A lot of times, when I was saying a lot of people think it's boring, it's just maybe there's a little bit knowledge gap. And on the other hand, I said that because it's shining, even in this time too. Because whenever people are downsizing or, all your 4Ds, they're following that, there is always need for storage. But still, I have a question in my mind. What future holds for storage? Because we might not look at storage the way we are looking at today. Did you ever think about that? Or, what market trends or macro shifts that you're paying attention to for the next few years, maybe? Because I just feel like, the way we are growing, or the way that technology getting advanced, things gonna change big time, because storage is not the same right now too, with the climate control and driving up to the storage unit and all, bells and whistles that you're adding, the luxury facilities for the ultra rich and all that. So do you see something in your crystal ball that what it's gonna look like?
Well, I think the automation, and they have it right now where you have one person or no people there. You can just go to your, rent a self storage facility. The
Mhm.
electronic locks. I think we're far away where you press a button and a storage container will just like come to you. I think that's not going to happen yet. I think maybe about 30 years, 20 years. I don't know. Maybe it will. You press a button and a container will come to you.
Yeah, but
And,
they're doing now the pods, right?
yeah,
You
like a
can.
pod, right? But they're not there yet. We're not there yet. And so you never know in the future what's going to happen, but definitely more automation, more systems, more control of your own storage center. You can look into your own like storage. You can see what's going on. So it's more personal type of storage. What
The
do you
more
think?
d- the more developments that are happening, when we talk to builders of single family homes that are doing, tracts of land of either in Arizona or Las Vegas, or we're talking to a developer in Portland, the homes are smaller. Some of them don't have basements. The younger kids of this generation doesn't care about the basements, right? Which is fine until you move in, and then you realize you're going to need some storage. So people have toys that they put away for the winter or toys that they put away for the summer. People have jet skis that they put away. People have skiing equipment or stuff that they want to put away. So in my personal opinion, if anything's going to happen, maybe the units get smaller. So maybe you're not going to see the 10 by 30s or the 10 by 10s, and maybe they're 5 by 5s. But to be honest with you, per square foot, the 5 by 5s, you get a lot more money than you get for the 10 by 10. So if we could build smaller facilities and get more money per square foot, then that's a whole different business model that we're excited about. So I don't see self-storage ever going away. It started in the early 70s and here we are booming as strong as it was, 50 years ago.
Yeah, we may just have a technology shift, but I definitely
Yeah,
don't think that it's
technology for sure, Ben.
yeah.
Absolutely. Yeah. We're
Yeah.
going to shows right now. I'm sorry to interrupt you guys. We're
No.
going to shows right now and they're showing everything's virtual. You walk in there, the screen opens up and you have real time FaceTime like you and I are talking right now, right? And the person says, "Hey, this is what it looks like and I can show you the unit. You pay with your credit card, they unlock the door, you walk in, it has electronic lock on there." People like that because it's easy and it's convenient. I remember when I was in the mortgage business, I owned a mortgage company back in the late 90s, and we didn't take applications on computers. It was an old, form that we would fill out. And then computers came, and then everything made it easier. Then DocuSign came out, and we were able to sign the documents without going to a closing anymore. And then we had, making deposits on your phone. I don't go to the bank anymore, right? So banks have become smaller, but they haven't gone away. And I think self storage, if anything, potentially might get smaller units, but it's never going to go away. Not in
But
our
maybe,
lifetime.
yeah, or maybe like the way we're using parts now to move stuff, how you can order the part can come, you can just
Sure.
dump everything and you can move it. So maybe that's the future. The part can come home, you can dump everything and then you can take it to the storage unit and save
Sure.
it. And whenever you need, it can bring it back to you. I don't know, I'm just
Absolutely.
thinking out loud, what would it look like the future, just trying to
Yeah.
peek into the future.
Well,
But for now,
Yeah.
let's check oh, you have something to say, go
well, I
ahead.
was going to say, don't give away your great ideas to all your audience. I mean, you should keep that for yourself. I'm taking good notes. I like that.
Like my background, you have your multifamily here and you have your self storage here.
Sure.
What can you want? It's a beautiful world,
That's exactly right.
right? Bill, I want you to plug Feed Six in if you don't mind. What we do for giving back to the community.
Oh, that's kind of you. 14 years ago, we're always looking back how we give back to the community. So 14 years ago, I co-founded an organization called Feed Six, and that's www.feed6.org. And what we do is we bring hundreds of people, sometimes thousands of people together, and we do meal packing events, and then we donate all the food to local food banks, food pantries. I've done 9 million, almost 9 million meals this year. It's been 14 years since I co-founded it, and all the meals been here in the Chicagoland areas. But I partner with big organizations. I did 1 million meals with ARP and NASCAR. I partner up with Underwriter Laboratories, Blue Cross Blue Shield, Humana. I mean, a lot of organizations, including real estate offices like Keller Williams, and we bring the employees together. They feel good because they're doing something. It's a bonding and team effort together, and then we donate these meals. So we've been doing it, and this is a way that we give back to our community. We're trying to get the self storage developers. I'm sorry, the Self Storage Association, maybe next year to do a big event with all the self storage developers and
Wow.
operators. Yeah.
Great.
Very nice. I love that. That's very nice. So I'm going to ask you a couple of questions from the investor perspective now, because it's such a strong wealth building strategy. Up till now, what we were talking about is just to, all the good, bad, ugly about the self-storage, and what it's going to look like in the future. So let me ask you this question now. For someone listening who has capital, maybe from a flip or a cash flowing rental, and they are ready to diversify, what is the first smart move into self-storage?
Call us at www.self-storagedevelopers.com. And you look, I even put a little camera icon. Point it to the camera, and you go right to the website, fill out the form, and we'll be more than happy to talk to you. That's what you do.
I really, really like that. But seriously, from the knowledge base, what would you recommend? What would you say someone's hesitant, maybe think storage is like not their cup of tea, it's too complex, or it's kind of a niche, they never looked into it. So how would they get started?
Sure. Ben will tell you something, and this is interesting to know. It's we don't just build storage, we design wealth vehicles, right? It's a way for somebody who has money, either from a 1031 exchange or some passive income. They want to put it somewhere for longer term, something that they're going to leave behind for their children, or something that they want to have later on when they retire. We're always happy to talk to people. We really are. Ben and I are open. I was a guest on a podcast show, I think a couple of months ago. Somebody heard it. They reached out to me. They said, I've never invested before. We spoke on the phone for about half an hour, and I told them, don't get involved in self storage right now. Why don't you buy yourself a four flat? I gave him a phone number to a mortgage broker that I'm friends with. I gave him the phone number to a broker that I know. And right now, he's buying his first four flat. He's got great credit scores. He has a good job. He's got some money. And I said, move into one of the units and do this first. So Ben and I love talking to people. If one of your listeners wants to reach out to us, we could tell them everything we know about self storage and why we think it's a good investment. But if we don't think it's a good investment for them, we don't want to take their money and put it in something that's not right. All jokes aside, it's not right for them. It's not right for us. They have to be the
Right.
right fit for both of us. But we're happy to talk to anybody and give them our advice and send them to the right people to work with them. And also, we have a third party administrator that we always work with. So whenever somebody invests money with us, it does go through a third party administrator who verifies that they're an accredited investor, verifies that they want to be involved in self storage, They look into the financials as well as the reporting for the investors on our behalf. So we have another layer of certainty for the investor when they get involved with us.
Hey, thanks for sharing that. Oh my God, I'm just getting so much knowledge from you guys, and I'm getting really, really confident about the self-storage. I do have myself as well, 600 units we did ground up build, and pretty happy about that. And I would say this is a solid wealth building strategy, and everybody should look into that because it's kind of hands off, whether you're passive or active. If you're passive, is even good because somebody else is managing it for you. And then talk to you guys. I guess that's the best thing we
Yeah,
can do.
I agree. And I want to include one more thing. We're always talking about ground up or conversions, but people who are currently have self storage facilities that don't understand what's happening or can't get it ramped up or have problems, have them give us a call.
Right.
We could definitely look at it and see what's going on, because we
Yeah.
have such an experience doing this and with our backgrounds, like you said, sixing, all right, lean, but we do have an experience in that. We can help them out and see where we
Right.
can go.
And if they have land, Vinky, that they want to maybe do some kind of joint venture, we're open to that. We actually have one partner right now that has a beautiful piece of property. They found Ben and I. They reached out to us. We did our research. We liked it. We talked to Public Storage. They like it. We have a model put together. We're already talking to the banks regarding financing. So they own the land free and clear, and they didn't know what to do with it, and they found us, and we're going to partner up with them. So if any of your listeners have property that they either own free and clear or don't have a lot of debt on it that are interested in maybe a partnership, it doesn't hurt to look at the market and we can tell you if it's something we can co-develop together. You never know.
Yeah, definitely. Yeah, that's a good strategy too. That's to say there's multiple ways to build wealth. And that's our show is all about the Wealth Vibe show, to share the different strategies and see what resonates with somebody. So this brings us to our rapid fire round. I'm gonna ask you 5 questions. So each one of you have to answer, okay? Not just one pencil, because both are here. So you both should answer. So there's no right or wrong answers. Whatever comes to your mind first, we'll run with that. But we're gonna do it really fast, okay? So who wants
Excellent.
to go first, Ben or Bill?
Bill can go
Ben,
first.
Ben. I'm joking. I'll be happy to go first.
I'm gonna ask one questions. You both gonna answer. Just go one by one, okay? First question is one word to describe self-storage investing.
Oh, resiliency for sure.
Oh, that's what I was gonna say.
Oh, okay.
Beautiful. Bulletproof.
Take it. Biggest myth about passive real estate income.
The biggest myth? Oh boy. That's a good question. The biggest myth about passive income. Um, I guess I would just say due diligence. Always look at the deal. Yeah, I do that for myself.
In marketing, you have to continuously. You can't sit back.
Okay. The next US market you're watching right now.
We are looking at Arizona.
That's a good one.
Yeah, well, we're looking at California.
California is a good market
Mhm.
because I do see a lot of self-storage popping up here there as well. So the next question is book that changed your wealth perspective.
I'm writing a book right now, and we'll talk about that another time. But The Millionaire Real Estate Investor by Gary Keller.
Oh, I like that one. I have that one too. How about you, Ben?
Oh my God! You know what? I'm a champion for quality, right? So I Dr. Deming's books is what I read. So that a lot of the the process improvements to building wealth. I mean that's what I read.
Yeah, I like that too because you need to have your systems in place to
Yes.
get somewhere. So the last question is one wealth building habit that never fails.
One wealth building.
Habit that never fails.
Oh, wake up early in the morning and plan your day. For me, it's getting up, writing what I have to do, because as soon as you get to work, there'll be more work to do. So plan your day.
I agree.
Exercise.
Medical.
Exercise.
That's a good one too.
You
Because
have
that
to
gives
exercise. You're exercising your mind. You have to exercise your body. And
wow.
Was that a shot to me? Because I don't exercise, Ben.
no, no, it was not. No, it was not.
No, I know
It
it's
was
not.
yeah, I wasn't looking at you when I said that.
Yeah. But thank you guys. This was such a power pack episode. It was humorous. It was everything in this episode. I think this is the best episode I had so far.
Oh,
Thank you
thank you
so
so
much
much.
Thank you so much.
for sharing such powerful insights regarding storage. And to the Wealth Wife family, if this conversation sparked some new ideas or opened up your mind for new possibilities, stay tuned or reach out to Ben and Bill to learn more about it. So until next time, stay focused, stay intentional, and keep building your Wealth Wife. See you guys.
Thank you.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.